This week on the Wall Street Report, the market hasn't skipped a beat all year. But it's April, and starting every April for the past 3 years, the market sold off through October. Will this year be the same? Our experts share their outlooks for the economy, the market, and where to invest now. Hi, everybody, and welcome to the Wall Street Report. I'm Jennifer Schonberger. Here we are in April, asking the same question posed over the past 3 Aprils. Will we break the summer slump in the stock market and the economy this year? Since 2010, both the economy and the market have started the year off strong, only to weaken in the spring and summer and pick up steam again in the fall. If we were to break that pattern and the economy were able to sustain a higher pace of growth, that would be a big positive. So what could be different this time? Housing. Housing is finally contributing to gross domestic product. It had been weighing down the economy for 6 years. As home prices have risen in recent months, more folks are seeing equity replenished in their homes. That is, more Americans are seeing their wealth restored. Since home equity is the greatest source of American wealth, it also has a positive effect on psychology. The improvement in housing is making people feel better off financially. It's a change that could underpin consumer spending. Time will tell. If it's not disappointing earnings or a shock from Europe, a downturn in U.S. economic data will derail the rally. It all comes down to expectations. The market is a game of cat and mouse between perception and reality. If expectations are irrationally high, then chances are economic data will fail to impress. That would cause stocks to fall. Just look at Apple as an example. The company's earnings repeatedly crushed Wall Street analysts' estimates until investors' expectations became too high for the company to beat, and the stock sold off. Same principle here. Watch the economic data carefully in April and May for any signs that growth may be weakening. That will be your sell signal. The S&P 500 soared 10% in the first quarter, while the Dow jumped 11%, clocking its best first quarter since 1998. But if history's any guide, the party could end in April. Over the past 3 years, the market started the year strong, only to sell off in April through October, then rally into the end of the year. So will we break the summer slump in the stock market and the economy this year? Here to weigh in on that question, the outlook for Europe, earnings, and where to invest now, are Sam Stovall, Chief Equity Strategist for S&P Capital IQ, who is joining us over the phone, Wayne Lin, Chief Strategist and Portfolio Manager for Legg Global Asset Allocation, and Jim Welsh, Tactical Strategist for Forward Management and Manager of the Forward Tactical Enhanced Fund. Gentlemen, welcome to the program.
Happy to be here.
Thank you.
I want to start off with the economy. Sam, the economy seems to have picked up steam in the first quarter after weakening in the fourth quarter. Do you think the economic momentum will be sustained into the spring and summer?
Yes, I think, but if you use the term momentum, I would use it with a lowercase m. We're still calling it a low-flying recovery that has been able to improve on its altitude, but we still think that it's going to be a below-par improvement, maybe showing between 2.7 and 3% growth for all of 2013.
So what do you think is perhaps going to be different this year, Sam, than perhaps in the past 3 years? What's going to make up the difference?
Well, we are seeing an improvement in housing data, so that's a positive because we're still expected to see a double-digit increase in residential construction. We've also seen a slight downward movement in the unemployment rate, with portfolios moving up. That's adding to the wealth effect, and also with personal incomes and personal consumptions, it just shows that the consumer is a little more confident about their own jobs and their willingness to spend money.
Jim, do you think we'll see the economy weaken in the second and third quarters of the year?
That's my guess, Jennifer, for a couple of reasons. Primarily, it's the cumulative effect of the tax increases that happened in early January. I think a lot of economists expected consumers to pull back right away. My take was that if you look at median income, it's $50,000. The 2% Social Security tax is about $1,000 a year, $20 a week. And I don't think most consumers are going to immediately decide we have to, cut back on spending. We're not going out to dinner. We're not going to the movies. But I think the cumulative impact of having less net pay will begin to wear on consumers. And I think we're starting to see some evidence of that, Jennifer, in the sense that the savings rate dipped to about 2.6% in February. That's down from over 5% in early 2011. We saw credit card balances begin to increase as well. But I think it's the cumulative impact from the tax increase plus the sequester is going to take time to ripple through the economy.
I understand what you're saying about the consumer, Jim, but I wonder, given the improvement in housing that we've seen, does that help offset some of that? And also, if you look at the GDP pie as a whole, perhaps, yes, the consumer will be weighed down, but does the business side of the equation actually pick up the baton, right? We've seen an increase in CapEx spending in Q4 on a rolling 3-month average that has been up every month since October. Can some of those factors, as well as the Fed stimulus, help offset that if you look at GDP as a whole?
Absolutely, those things are going to be a plus and help offset some of the drag from the consumers pulling back. I think the key point here, Jennifer, is a lot of expectations going into Q1 were quite low. They looked at the fourth quarter, people thought, oh my goodness, minus 0.1 was the initial report. My take was that the economy was really quite a bit stronger in the fourth quarter than it appeared. Final demand was up 2.3%. Two special factors impacted the fourth quarter. Inventories dropped 1.3% off of the fourth quarter GDP. Defense spending had its biggest decline in one quarter in the last 40 years. Those were special factors. So I think the real test is most economists expected the economy to be slower in the first half, and then they're expecting an acceleration in the second half. And I think that acceleration expectation is what's likely not to be achieved.
Wayne, where do you stand on the economy? Do you think the economic data is finally catching up to the stock market?
Well, I think that the stock market is a forward-looking market, and it is reflecting signs of economic improvement within the U.S.
Before we get into the discussion on the market, I have one more question on the downside risks to growth. Sam, something a lot of folks aren't focused on is that consumers and businesses are likely to start feeling the impact of the new healthcare law this year as opposed to next. Are you worried that the new law will act as a drag on job creation, potentially increasing the cost per worker, as well as for consumers who could see increases in their premiums?
I think that is a concern that we have to contend with. Those companies employing greater than 50 employees will have to be paying their increased healthcare tax, and if not, then they have to pay a penalty on that. So certainly there could be a drag, but the stock market seems to be looking past that, similar to what it did with the increase in the taxes at the beginning of this year, and also the worries about the sequestration kicking in. So right now it seems as if the stock market says all of these items are things that we are able to work around.
Getting back to the discussion on the market, Wayne, what's your outlook for the stock market? Will we see the sell-off that starts in April and goes through the summer months that we've seen over the past 3 years?
We don't think so. We think that equities are fairly valued right now, and given the economic data that's coming out, economic growth will be sustained, barring any kind of event risk coming out of Europe. We feel that earnings will continue to perform, although earnings growth will be challenged, we believe. And so, you're probably not going to see a huge run-up, but we don't see anything in the next 3 quarters that could sort of derail the stock market.
Jim, as a technical strategist, when you look at the vital signs of the market, what are they telling you now, and how does that tie in with your outlook for the economy, which you expect to weaken in the second half of the year, while it seems the consensus on Wall Street is for the economy to actually pick up in the second half of the year? Are we setting ourselves up for a big fall in the market?
The technicals are actually in pretty good shape, Jennifer. A couple weeks ago, 713 stocks made new highs. Last week, 622. The advanced decline line also made new highs. So from a technical standpoint, the market is in a very healthy place, which is why my expectation of disappointment is months out, because the technicals are usually a sign of what's to come down the road, and the strength of the recent rally has been pretty impressive. So although I think we're near a short-term high, technically the pattern from last November, you can see 5 waves up on the S&P 500. Sentiment has become a little bit more bullish. We have a number of strategists raising the targets, which is typically what happens near the end of a pretty good up move. So I think the high yield bond market is not keeping pace with the stock market, which has historically also been a warning sign. So I think we're near a high. I'm looking for a pullback. Then I think we're going to get another rally. And if the subsequent rally is really strong, then that would push back, I think, the economic slowing that I would expect. So
well, when would you expect the first pullback to occur, Jim?
Very soon. I'm not looking for much in the short term, Jennifer, just because the momentum is there. Bullishness, buy the dip mentality is kind of ruling. So I think the next couple of weeks could be choppy. At most, I think 5% down towards 1,500 would be my guess.
Sam, what's your outlook for the market? Do you think we'll see a summer sell-off?
Well, historically, there is that old saying of sell in May and go away. The market has risen an average of 7% from November through April since World War II, but only about 1% from May through October. I would tend to say that what investors are most looking for usually does not happen. So maybe we end up seeing a very slight digestion of recent gains, but possibly not the steep sell-off that we saw in 2011 and in 2010.
Yeah, and I also have in my notes, you, Sam, increased your target on the stock market for the next 12 months, right? You're expecting 1670, and that's up from 1550. That's a big jump. Why did you move your target upwards?
I think it was a combination of both inertia and realizing that the market probably won't be providing us with that better or more attractive entry point as a result of a decline in prices. But basically, we could still justify where we think we'll be 12 months from now based on earnings growth and based on PE multiples. And even at the multiples that we're projecting, we're still going to be trading at a fairly hefty discount to the median over the past quarter century.
Turning to Europe, Jim, have investors become too complacent about Europe?
Yes and no. I mean, no from the standpoint that Draghi's comments and the decline in rates that we've seen across Europe, specifically Italy and Spain, been very helpful for them to roll over debt. I think they've been complacent in the sense that the economic environment in Europe continues to deteriorate. The unemployment rate just reached a new high, 11.9%. Bank lending represents 80% of credit creation in Europe. So a functional banking system is critical. In the U.S., banks provide 35% of the credit. This is important because in February, bank lending continued to contract. So my guess is that we're going to see the weakness in Europe persist through 2013, and some of the problem childs in terms of Italy and Spain may come back into the forefront.
Sam, are you surprised that U.S. stocks haven't been rattled as much as in the past few years by what has been going on in Cyprus and in Italy, right? The lack of ability to form a coalition.
Not really. I sort of equate market tensions to that of dropping a ping pong ball on a table. The first bounce is the most severe, and then subsequent bounces are more muted. Also realizing that Cyprus is about the size of Vermont from a GDP perspective. If you thought Greece was small, just take a look at Cyprus. So I have a feeling that investors believe that this, too, is something we will work around.
Wayne, do you think that investors have been overly complacent in the U.S. about what's going on in Europe?
No, I mean, I agree with a lot of things that Sam has said, but really from a market impact perspective, Cyprus is not, is not a significant part of the European market and the European market cap. I would say, however, the fact that they did sort of bail in the depositors, it is a negative signal, I would say, in terms of the progress. I view it as a step back in terms of the progress of unified banking in Europe, which is ultimately where the European Union needs to head. So, from a pragmatic perspective, no, not a big deal. From a symbolic perspective, it further illustrates the power of being centered in Germany and the fact that it is still a fluid situation.
Turning to the bond market for a moment, Wayne, the bond market has had a tendency to lead the stock market. What is the bond market telling you now that perhaps the stock market is not factored in, right? We've seen yields on the 10-year that had kind of bumped up above 2% have now come back down.
Yeah, I think the bond market is basically telling you that the Fed wants investors to go out on the risk spectrum, and that it's largely a reflection of current monetary policy. So, I think that the loose money is going to be here as long as inflation. As long as unemployment is high, and as a result of that, I think that people are looking at the relative attractiveness of bonds, where the 10-year at whatever yield that you're at now, plus or minus 10 basis points, you're still looking at a negative real return versus stocks that are, as Sam had said, and I agree, are reasonably valued and can provide a positive real return. I think if you're looking at those two and you're comparing, it's going to tilt you towards the equity market.
Yeah, to your point, Wayne, we've been hearing a lot about the potential for the great rotation out of bonds into stocks. We haven't really seen that yet. Is it, you think, because the Fed is kind of tampering with the bond market and keeping yields down and prices high? And so until investors really feel the pain and lose money in bonds, we're not going to see that move into stocks.
I think that's very true. And I think that in part, but I do believe that investors in general are becoming aware of these risks, and it's really a waiting game between when the Fed decides to tighten or actually stop the bond purchases versus when as compared to what equities would do. So there really is, when you're back to Fed watching with the bond market. But the problem, the issue this time is that the implications and the potential capital losses are far more severe than they have been in historical circumstances.
Let's talk about earnings. The first quarter earnings season is kicking off. Sam, what are your expectations for first quarter earnings? Do you think we'll see some surprises to the downside?
Well, S&P Capital IQ consensus estimates point to only a 0.5% increase in the first quarter. What's interesting is that in the beginning of the fourth quarter reporting period, both the fourth quarter of 2012 and the first quarter of 2013 were expected to show similar advances of about 3.5%. But as the fourth quarter earnings grew, it seemed to be taking away from the first quarter 2013 estimate. So right now the bar is set very, very low, and just knowing corporate management's ability to guide expectations, my belief is that they'll probably surpass those expectations once again.
Wayne, you're concerned that estimates could be a little bit too high here, and that earnings could be a bit of an obstacle for the market, right?
Well, yeah, exactly. We're looking at it in terms of year-over-year earnings growth and how the global economy feeds into that. And we're seeing really the global economy within the U.S. There's potential for a cyclical upturn. In Europe, though, we're still facing challenges in terms of economic growth. And then China, there's some positive signs coming out of China, but still it's going to be a more subdued growth rate than it had been prior to the financial crisis. So we're watching closely, and we take a view on where economic activity is and translating into earnings growth. And we don't really see where the earnings growth is going to come from going into this year.
Jim, what about the impact of the stronger dollar on multinational companies? Do you think that's going to hurt earnings in Q1?
Yeah, I think we're going to see some comments from some of the multinationals, Jennifer, addressing that. And then the key comes down to is if the dollar continues to strengthen in the second and third quarter, that will become more problematic. Because the dollar strengthened not only against the euro, but it's obviously strengthened significantly against the yen. And so it's just going to be a tougher sales environment for U.S. companies out there. And the translation of earnings is also going to be a headwind. And right now, no one's paying attention to that. But I think as we get down the road a piece, I think more attention will be paid to it. And I think it could be one of the reasons why the market faces some trouble in the second half.
Sam, what do you want to hear from companies, or what are you looking for when they're reporting? Are you looking at their outlooks?
I'm looking for the quality of earnings. Where are the earnings coming from? Is it still cost cutting? Is it still share repurchases? Or are we actually seeing an organic improvement in earnings domestically as well as internationally? I'm also looking to revenue gains. We saw revenue improvements of close to 5% in the fourth quarter of 2012. The estimate now is for a 4% increase in the first quarter of 2013. So quite frankly, I'd like to see top-line growth go along with whatever bottom-line growth there ends up being.
All right, let's talk about where you're all finding opportunities now. Jim, your fund, which is quant-driven, is 100% in cash right now. Would you recommend avoiding buying stocks now, given that major averages are at or near record levels?
It's a tricky question in the sense that as we get near 1576, Jennifer, which is the high from 2007, the intraday high, it would be very unusual for a market that is as extended as this is to punch through that level on the very first try. So my guess has been is that we will try to push through, and maybe last Thursday's high at 1569 was that first attempt. But I think the probabilities are that we'll see some kind of a choppy period that will probably end with a pullback, 1500, 1520, before the market tries more seriously to punch through that 1576. So I think for most investors waiting for a pullback, I think the patience will be rewarded.
Sam, do you want to be in multinationals now, or do you want to look toward mid caps and small caps that derive more of their revenue domestically as opposed to internationally, given what's going on with global growth right now?
Well, it does seem to be that the U.S. is the best house on a bad block. And so while the GDP growth is probably stronger in the emerging markets, I think people are questioning a lot of the reform movements that are going on in China, in India, et cetera, and would rather keep their money close to home. And small and mid-cap stocks have been showing greater earnings growth and, as a result, greater price appreciation. But I do worry a bit that the valuations are getting stretched. So I would tend to say, maintain some exposure to mid and small caps, but don't go overboard. Realize that if we do start heading into rough seas, investors prefer a larger boat.
Wayne, how are you positioning your portfolio now between stocks, bonds, cash, as well as other assets?
Well, currently we're neutral. Again, we think that equities are fairly valued. We don't like valuations on treasury securities. So we're sort of waiting for signs of economic growth and the potential for stronger earnings to kind of tilt us a little bit more towards equities. We do like REITs. Traditionally, we look at REITs versus what the corporate bond yield is. And they do look attractive at this point in time. And from the perspective of commodities, again, with our worries about sort of just middling growth, we're underweight commodities. So that's how we're positioned right now.
Sam, what are your favorite sectors right now? And from there, if you could rattle off a couple of names.
Sure. First off, historically, it's very interesting, but if you focused on those three sectors that were the best performers in the first quarter of a particular year, on average since 1990, they beat the market 8.5% versus 6.5% for the market as a whole. But following a strong first quarter, what we find is that the sectors tend to do even better, gaining an average of 12%. So the implication is that if we started off this year doing fairly well with the defensive areas of consumer staples, of healthcare, as well as with utilities, you might want to be looking in some of those areas. Companies in the healthcare and utility area, I would say focus on quality. Focus on those companies that have increased their earnings and dividends in each of the last 10 years. Johnson & Johnson would be a good example in the healthcare space. General Mills would be a good example in the consumer staples area. And then One Oak is a company in utilities that also fits that criteria.
Gentlemen, great discussion. Thanks so much for your insight. Hope to see you soon. And that's our show. Thanks so much for tuning in. As always, watch us online at www.youtube.com/Wall Street Report. Email us at wallstreetreportwithjen@gmail.com and follow me on Twitter @Jenniferisms.